All right, so I'm on page 4 of the module 5 notes, right after the examples of discontinued operations. Orient yourself, pause the video if you have to. The presentation of discontinued operations. So we worked through an example where I had an adjusted balance for the entire company. And then I showed, well, what would it look like if we didn't discontinue, right? Just a normal multi-step income statement. And then I said, well, if we do discontinue, then I separated out the discontinued divisions, revenues and expenses, got their income, just the income for the discontinued division. And then I presented what the income statement would look like. And that income statement at the top portion, right? At the top was all about the continuing operations of the company. We just took the sales revenue from the continuing operations. We took the cost of goods sold from the continuing operations. And we derived the whole thing all the way down, took a tax expense, and then I got a total. And I said, hey, that total is no longer net income because it does not include all the company. What that became for that is the income from continuing operations. And so that's really the first step when we are disclosing disc ops, is that you have to assess everything and including tax expense, but only for the portion of the company that's continuing. So this is net of all discontinued operation revenues and expenses, just like that example. So after that, after we have that subtotal, we then need to disclose what's going on with the discontinued op. The first piece and the piece that I derived is that income or loss from operations. We had income. We had income of 1.68 or something like that, right? That is the discontinued operations up to the measurement date. So we're talking about, hey, is this for the year 2023? That's 12/31/2023. That's the measurement date. Um, Net of tax. And we took that tax out, right, of the disc ops. So that is, again, just the discontinued division. We netted that out of the top. We took it to its separate income statement and then derived what that came to. What is the net income of just the discontinued operations? So we're calculating that income for the portion of the company, and that portion is the discontinued portion of the company. Now, within that, we can include any impairment on and any impairment loss on that division if it's necessary. We're going to talk about impairment loss a little bit more below, so don't worry about now. The other thing we would need to include is a separate line item from that income or loss from the discontinued company is any gain or loss we got from the disposal from selling it, right? So disposing means selling. So if we're discontinuing, we're going to sell it off. Now, we have to calculate our gain or loss from selling it off. Remember, gains or losses are recorded when we sell long-term assets. We do not call that revenue. We do not call that expense. We call it a gain or loss. And we calculate that gain or loss by taking whatever the sale price we get is of that item. And we subtract off the book value of net assets minus the book value of liabilities. The book value of net asset, or the book value of assets minus the book value of liabilities, is the net assets of the company. And when I say company in particular, I mean the net assets of the discontinued division or operation. And if we're talking about net assets, assets minus liabilities, remember that assets minus liabilities is equity. Equity is how we value a company. Because a company is not simply valued by all the assets it provides. Yeah, you've got a bunch of assets, but you also have obligations that you have to pay off that you're taking on when you buy a company. So the true value of a company is its assets less its liabilities. Now, we also need to subtract off any cost to sell, because there are undoubtedly going to be some sort of legal costs, contract drawing up, maybe some accounting costs that you have to embrace in order to get this thing in a state that it could be appropriately, transparently reported to the seller, to the buyer, so that they'll be interested in buying it. So any costs to move this entire division of your company, right, are going to be subtracted from this as well. So we take sales price less the net assets of the discontinued operation, less the cost to sell. And notice, please notice order of operations, that I am subtracting this net asset, taking the net assets first, right? Then I'm subtracting off cost to sell, and then I'm subtracting all of that from the sell price. All right, so here's an example, a very small example of a discontinued operation statement. Here, the tax rate is 40%. So this is all the revenues and the expenses of our continuing portion of the company, including just the continuing portion. We take the tax expense, 40% of 1,000 is 400. This is my income from continuing operations. So there was a lot of stuff that came before this, all the sales revenue, cost of goods sold, operating expenses, non-operating income items, right? All of that comes into this subtotal, but I just don't want to list the whole thing. Now, after we have that income from operations, from continuing operations, we've netted tax. We subtract, we now do this disclosure of the discontinued op. We have two pieces here. This time, the net income of the discontinued division was actually a net loss. It was a net loss, and we netted tax effects, $120 of a loss, right? Now, we do display the net of tax effect. So this was, and this is something that not everyone is familiar with, we had a net tax effect of 80 and we had a loss of 120, which means that for the discontinued division, so my disc operation came to pre-tax of negative 200. That was our pre-tax loss. Now, when you have a loss, the tax is no longer a tax expense. It's actually a tax abatement. It's a tax savings, because we don't pay taxes on losses. We only pay taxes on profits. So if we have a $200 loss, then rather than paying $80 of additional tax, we get an $80, tends to be labeled as a tax provision because it's no longer an expense. And that leads me to a $120 loss. So some of my loss is reduced by the fact that I had a loss and I get some tax savings off of that loss. So this is now my net loss, which is reported here. Then we have the second thing. This is where I sold it, the gain from the disposal. And I ended up netting $30 from that. net of that tax effect of 20. And so again, if we just separately looked at that gain, we said, yeah, I got a $50 gain in this case. But because that's positive, I now have to pay tax on that. So that is tax expense. And that would be the $20 disclosed here, which gives me the net of tax gain of 30. So we don't tend to do this. All the items that were reported above the tax line are reported pre-tax. So for the continuing operations of the company, all of that stuff that was up here that I didn't put out here, the sales revenue, the COGS, the operating expenses, the non-operating items, all of those were pre-tax because then I summed them all up, right? I brought them all together and I got 1,000. And then I took a tax expense on all of them. But when we come down below the tax line, we start taking tax off of individual items because they're no longer a part of this cumulative tax expense. They were not factored in up here. So they're not a part of this 1,000. Their tax is not within this $400 number. So they have to have taxes separately taken out. This is referred to as intra-period tax allocation. So how we distribute taxes within a year of the company. So let's look at how this works with an example of Rocky and Bullwinkle, which if you're as old as me, you would remember as a beloved cartoon. Rocky decided on March 30th to dispose of a component, Bullwinkle. Rocky sold Bullwinkle on November 1st for $1 million, at which time the book value of Bullwinkle's assets was $2 million. The book value of its liabilities was 1.2. From January 1st to November 1st, the Bullwinkle component had a net loss of 150, assume a tax rate of 40%, and income from continuing operations after tax of 750. So who is the discontinued? Let's make sure we got that straight first, right? Rocky sold Bullwinkle. So the moose was the one that was sold. Bullwinkle is the discontinued component. Now we start with income from continuing operations. This is Rocky. It says that the income from continuing operations, the continuing is the Rocky piece. So all of their net income, cost of goods sold, operating expenses, non-operating items, and tax, because it's after tax, was $750,000. So up here, we're not even at income from continuing operations before tax, right? I'm giving you the after-tax amount. So this 750 is actually right here. It's the income from continuing operations. So we're reporting all about the Rocky piece of this company. And that is $750,000. Now we have to disclose what happened with Bullwinkle. So the discontinued operations come next. Remember that we got to report two things. First, what were Bullwinkle's piece of these operations? What was the net income or loss of Bullwinkle? So the Bullwinkle component had a net loss of 150. That net loss is, if I call it a net loss here, do I specify anything about pre-tax, after tax? No, don't say that it's after tax or pre-tax. So if this loss is net of its income tax, then we can report it straight at 150. So we call it loss from discontinued operations. We will have to signify net of tax so that it's very clear that this amount has been stripped of taxes and it is a loss. So it is $150,000. I'm indenting it just a little over here because I'm going to aggregate this with another piece to get the full effect of the disc ops. Now it tells me that they sold Bullwinkle for $1 million. And at that time, the net assets were 2 million. The book value, sorry, not the net, the assets were 2 million. The book value of the liabilities were 1.2. So I go back to this, right? I look at what is the gain or loss. So this $1 million is my sale price. And I subtract off the book value of net assets. Now, the book value of net assets, right, is the book value of its assets less the book value of its liabilities. So that is 2 million less 1.2 million. Now you see why I oftentimes choose to use M's and K's instead of writing everything out. It's a lot of zeros. All right. It doesn't mention any costs to sell. So that's not a part of my calculation this time. Right? We just go straight through this. 1 million here, 0.8 million here. So I have 0.2 million. This is my pre-tax gain, right? The amount of the sale price was greater than what I gave up. And typically that's how I think of gains and losses. What I got versus what I gave up. And we do this in terms of the book value of what I got and the book value of what I gave up. And remember, book value simply means what I find on the income, what I find on a financial statement. So that's pre-tax, but I got a net tax when I'm below in this discontinued op area. So in this case, I would, yes, label it as a gain, but I take the 0.2. And if I'm applying a 40% tax rate, then 0.02 million times 40%. That would net me 0.08 million, which would turn into 0.12 million or $120,000. Right, so this is $120,000. This is my net gain on the disposal. So this is my gain on disposal, net of tax, $120,000. Now you can include the dollar values here. And that, oops, and just, it's a gain, you don't subtract it, right? Sorry about that. So now we look at the cumulative effect. I'll come back to that piece in a second. We look at the cumulative effect. The cumulative effect is a reduction of $30,000. So if we consider the entire effect of this discontinued operation, it reduces by $30,000. Then my net income here is going to be $720,000. And remember, net income includes the entire company. We can't call something net income without an appeal to the fact that we are assessing the income from the entire company. What I was going to say about the net of tax, yeah, you can put net of tax. In this case, it would be 80,000. Now, how can you tell what this is net of tax? What tax was taken out of this? Well, you're going to have to do a little bit of algebra. If this is what's left over after tax, right? So if we're thinking about this is, if the tax rate is 40%, this is 60% remaining of the full amount. So then just bring out that to a little algebra over here. If 150,000 is what's left, after multiplying something by 60%, then we can figure out what the full amount was. Okay, so in order to find that, we divide 150 divided by 0.6. That means 250,000 was the pre-tax amount. That's called grossing up. When you are going from a discounted price to the full, right? But you have to understand whatever this discounted represents, in this case 60%, you divide it by that percent to get the full. And now we can multiply it by the tax piece, 40%, to get what the tax effect was. All right. So now we got the absolute complete disclosure.